Hey, Steve Saretsky here. As always, this is Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value entertainment out of these videos, all I ask you, hit thumbs up and subscribe. Questions, comments, put those below. I mentioned in my video last week that there's potential distressed opportunity in Calgary. For those of you who emailed me and reached out, I'll have more details on those in the next week or two. I'm hammering out the details with the developer earlier next week. But in order for me to put my brand and reputation on the line, I have to be comfortable with the numbers to actually vet it out and make sure that it's a good deal that I'm comfortable actually promoting and putting my name behind. And which really brings me to the larger scheme of these videos is that I think particularly people in the industry ask me. I think there's a lot of confusion out there as to why Steve do these videos. I don't get it. Why is he so pessimistic or bearish on the Vancouver housing market? And if you haven't figured it out by now, it's really part of a larger brand play in terms of what you're trying to build for the future. I think again this is essentially a brand building exercise. I think in order to build brand today, you have to garner trust, and in order to garner trust, I think you have to speak your authentic viewpoint. Whether people agree with that viewpoint or not is irrelevant, but I think staying true to that message. And so it's funny because last week I had someone comment on my YouTube video, which I actually pinned to the top of my page for all of you guys to see, so you can go back and look at that comment. But basically the guy said, anyone that has watched Steve's videos, congrats that they relied on your information to trying to time the market, and there's been no housing bubble hasn't burst, so kind of jokes on you sort of thing. To which I replied, and I'll reply in this video, is that first of all, it's never been about timing the market. I've been working with buying clients for the last each year over the last 2, 3, 4, 5 years working on this. So it's not first of all timing the market. And second of all, I've probably never been busier than this year. Despite the 20-year low in sales, I've never been busier working with on the buying side of clients, particularly looking for single-family homes who have enjoyed, I'd say, on average, about a 20% discount through choosing of their own goodwill to watch the videos and decide that they would prefer or have decided that they took their time to make a purchase and enjoyed a 20% discount. So, I guess good for those who I guess felt that at the time that was the decision they wanted to make. But long story short is essentially, again, this is a brand building exercise, and it's funny, in the realtor community especially, they're like, I don't get it. Is this guy selling houses? Why is he saying this? Shouldn't he be saying good things about the market? But again, this is from a larger perspective, looking 10, 20, 30 years down the road. It's really about building that up to then leverage into further opportunities. So when people come to you and say, hey, if this Vancouver trajectory continues, is there an opportunity for a vulture fund? Where the deal is going to be? And we're happy to basically cut you a check to find those deals and to be a part of those deals. And so I don't think you get those opportunities by trying to be, necessarily the best glorified salesperson as opposed to being a trusted authority. And so that is, again, the purpose behind the videos, if you haven't figured that out by now. This isn't about timing the market or being pessimistic on Vancouver just for being pessimistic. When Vancouver's data starts to change, not the goal, but the reality of it is you have to turn it to a raging housing bull. You can't be bearish. You see these blogs out there that have been bearish for 10, 15, 20 years, and it's like, no, man, you have to pivot with that. So I'm not going to ramble too much on that, but I just thought I'd make that note to people that are kind of curious, not only on the Calgary project, but the reasoning behind these videos. But one thing I wanted to touch on this week is, again, talking from a cyclical perspective. One of the things, if you look into the United States, during their housing bust, was the strong uptick in the number of delinquencies and foreclosures. And so if you look at the delinquency rates, those really started to spike beginning in sort of 2005, 2006 in the United States as home prices topped out and as distress started to ripple through the system. You had foreclosures, the number of foreclosure listings, and then vice versa, you had sales spike. And so that's kind of what you saw in the US, is those actually peaked in 2009, yet prices actually continued to fall and bottom in 2012. And so one thing I was saying was like, well, it's, you compare that to Canada, is that despite the 20-year low in home sales in Greater Vancouver, and despite prices coming down, I would say across the board, 20%, if you're going to average it out from single family houses to condos, you don't really necessarily see the distress. There's still, I think, an ample amount of credit available. There's certainly not an increase, or not a drastic increase in the foreclosures numbers. In fact, if you actually look at Greater Vancouver, the foreclosure numbers, the number of new listings, you can clearly see that we've bottomed, and the number of new listings are just now starting to tick up, and so sales will ultimately follow. But I think people are looking for sort of bottoms or what's to come. Is like, there's no doubt that even, despite where interest rates are, that the foreclosure numbers are going to, and they're going to have to pick up. And a lot of that distress is coming from the private lending space, the mortgage investment corporations that are equity lending, particularly, second mortgages. You're seeing a lot of those, not get renewed, and the number of foreclosures that are happening are coming from that space, not necessarily coming from the big banks. But what's interesting is I was actually just in a housing event earlier this week with hedge fund manager Seth Daniels. Actually, was able to sit down and have breakfast with him. But one of the things that we were discussing was, again, the sort of the low delinquency rate, in Canada, and particularly in Greater Vancouver. You're seeing this distress. Obviously, foreclosures are a lagging indicator, but part of that reason is that Canadian regulators, policymakers are very lax in that standard, that the banks, particularly the big Canadian banks, allow very generous workarounds in terms of delinquent borrowers. So they don't necessarily, just because somebody is delinquent on their payments doesn't mean the banks, similar to the US, automatically start their foreclosure process. Canadian banks are so generous that they're always allowing borrowers to continue to sort of work through their delinquency, try to get them to catch up. And so the banks say, we're working with them. It's a very long, drawn-out process before the banks actually say, okay, enough's enough. We're going to start the litigation process and try to seize the asset. So that's like the last thing. So the delinquency rate isn't necessarily, actually, it isn't a indicator of strength in the lending space. It's actually a very much a lagging indicator, and particularly so in Canada, where they're not aggressive in their foreclosure process. But I think with that being said, is that suppressing foreclosures is actually bullish for prices. So one thing that economists who wrote the book House of Debt talk about is they talk about the foreclosure process in the United States, and the fact that because the foreclosures spiked as aggressively as they did, this actually created a sharper drawdown in home prices. Because what happens is when you get foreclosures coming onto the market, it is a forced sale. The bank needs to sell the home. They're not emotional about the price. The home needs to sell. So they'll go through the process of selling the home. But when that home sells, it creates a new comparable market price in the area. So it basically affects all the surrounding homes. So as soon as that home sells, it impacts every single house in the block. And when these homes sell in an illiquid, distressed environment, they're creating basically a clearance price. They're a forced sale where they sell at generally a lower price than maybe a homeowner that tries to stick it out and try to, basically wait 6 months or 12 months to try to sell their home for top dollar. These banks are basically forced sales, creating essentially what's called, again, a clearance price. And so the fact that Canada is more conservative in their foreclosure process, I would argue, is probably more bullish in that aspect, but certainly it should take a grain of salt that looking at the current foreclosure rates or delinquency rates in Canada are by no means whatsoever a indication that Canadian lending standards are more prudent. I think it actually is quite the opposite. I think that they're very overly generous, and if home prices only go one way, which is up for the last 20 years, delinquent borrowers can catch up via the rise in home equity, which then will allow them to actually refinance and restructure that debt because home prices allow them essentially to bail themselves out. So I think that's important. That was kind of the one takeaway I had for this week. Other than that, kind of a slower week as we enter the summer months here. But yeah, if you want a sort of an update on the housing market, we discussed that the past week, so go back and check that video out. But anyways, hope that video helped. Otherwise, see you next week.